Welcome to the Opening Bell Report.
$108.86.
Yep, that's the number.
And it is. It's a very specific number.
It is. And honestly, right now, it might be the most important number in the entire tech sector.
It's the closing price for CoreWeave ticker CRWV on January 27th, 2026. And look, if you're tuning into this deep dive, you've seen the headlines, you know the story. CoreWeave didn't just have a good day.
No, it was.
Yeah.
What are the analysts calling it? A decisive breakout.
A decisive breakout. Nearly 11% in a single session.
Which is just massive. I mean, for a company this size, a double-digit move on a normal Tuesday, that gets everyone's attention instantly.
Exactly. And that's our mission here. We're not just going to read the scoreboard. You've got an app for that. We need to really unpack why this one company, this specific AI infrastructure play, is suddenly sucking all the oxygen out of the room.
Right. Is this just a flash in the pan, or are we looking at a real fundamental shift in the AI arms race?
To figure that out, we're working off a pretty comprehensive financial analysis report. It's dated January 28th, 2026. So we're going to dig into the technicals, the market sentiment, and what I think is the most important part, the competitor analysis.
I was looking at the charts this morning, and the sheer weight of the move is what's so striking.
It felt heavy, right?
Yeah.
It felt institutional.
It was heavy.
Yeah.
But,
Okay.
and maybe I'm teasing a little bit here, the price is just the symptom. The real story, the diagnosis, is all about who they're partners with.
I have a funny feeling that partner's name starts with an N, but let's not jump ahead. Let's start with the anatomy of the surge itself, because this wasn't some slow and steady climb, was it?
Not at all. The report calls it a textbook gap up open.
Okay, so for anyone who doesn't stare at candlestick charts all day, let's break that down. A gap up isn't just opening a little higher.
No. The stock closed the day before at 98.31, normal day. But when that opening bell rang on the 27th, the first trade wasn't 99. It was $103.70.
Wow, so it just teleported past all that resistance, skipped the line.
It skipped the entire negotiation. And it's not just the size of the jump, it's where it jumped. We've talked about these psychological resistance levels before. For CoreWeave, that big, scary number was $100.
The century mark. It's funny how that works, isn't it? A stock at $99.50 feels expensive, but the moment it punches through 100, the whole psychology shifts.
It completely flips. And $100 was a hard ceiling for weeks. This gap up didn't just tap on the glass, it blew the doors off. But here's the crucial part, and this is where you separate the hype from the substance. It wasn't a pop and drop.
The classic retail trap. Big open, everyone piles in, and by 10 a.m. the pros are out and it's closing in the red.
Didn't happen. Not even close. CoreWeave held that gap, and then they kept bidding it up all day. It hit an intraday high of, what, 111.79? But the real validator, the thing the report really emphasizes, is the volume.
Volume confirmation, meaning a lot more shares were trading than usual.
A lot more. You have to read between the lines on that. High volume on a breakout signals one thing: sustained institutional buying. This isn't just Robinhood traders. You don't see volume like this unless the big funds, pension funds, hedge funds are moving in and establishing a new floor.
And the report even notes it kept going after the bell.
Push right back up to 111.20 in after hours. That's just the big desks who missed the move during the day saying, fine, we'll pay a premium just to get in before tomorrow. FOMO is not just for us mortals.
Okay, so the technical picture is clear. A powerful, institutionally backed move. But a stock doesn't jump 11% because a chart looks nice. There has to be a story, a catalyst.
And that gets us to the absolute core of this whole thing, the NVIDIA proxy trade.
I've seen that phrase, the NVIDIA moat. It suggests CoreWeave is less of a standalone company and more like a leveraged bet on NVIDIA's dominance.
That's a good way to put it.
But let me play devil's advocate. I mean, every tech company on Earth has a slide in their deck about how much they love NVIDIA. Why is CoreWeave getting the 11% pop? What makes them so special?
It really boils down to being a specialist versus a generalist. The report using this phrase that I think is really sticky, it calls CoreWeave the AI factory.
An AI factor. Okay, what does that mean? How is that different from Amazon Web Services or Azure?
Well, think about what AWS is. It's an incredible business, but it's a generalist cloud. It has to be everything to everyone. It's running old banking software, it's storing your family photos, it's hosting websites, and yeah, it does some AI stuff too. It's a giant department store.
Right, I can get tires, milk, and a laptop all in one place.
Exactly. Now, the report states CoreWeave is, and I'm quoting, 100% optimized for NVIDIA hardware. The H100s, the new Blackwell chips, they don't do photo storage, they don't do websites, they do one thing: high-performance compute.
So if AWS is the department store, CoreWeave is, what, a Formula One pit crew?
That is a great analogy. Or think of it like a mechanic. You have the general shop that can fix your minivan, your truck. They're good. But then you have a facility that is purpose-built, down to the tools and the lifts, to only serve as high-performance Ferraris.
And if you just spent a fortune on a fleet of Ferraris, or in this case, a cluster of H100 GPUs, you're not taking it to the general mechanic.
You want the specialist. But it's even deeper than that. The report gets into the bare metal versus virtualization debate. It's a bit technical, but it's the key.
All right, let's get technical. What's the difference?
The generalist clouds, like AWS, mostly use virtualization. It's a software layer that chops up a physical server into lots of little virtual ones. It's flexible, but that software layer eats up performance. It's overhead.
Like a middleman taking a cut of your speed.
A tax on your performance.
Exactly.
CoreWeave specializes in bare metal. They give you direct access to the hardware, no middleman, no tax. And when you're running an AI model that costs $50 million to train, you can't afford to lose 10 or 15% of your power to software overhead. You need every single cycle.
Efficiency is money at that scale. So the investor takeaway is this is the infrastructure play.
That's it. If you believe NVIDIA is going to keep selling the hardware, somebody has to provide the best place to plug it in. It's the modern version of the picks and shovels play. CoreWeave is selling the best shovels.
Okay, the story's powerful. The Ferrari garage of AI, I like it. But now we have to be the adults in the room and talk financials. Because I'm looking at this report, and there's a pretty big number missing from their income statement.
You're talking about profit.
I'm talking about any profit at all. They're losing money. They're burning cash. How does a company that's losing money rocket up 11%? Why does the market not care?
It's the classic infrastructure build-out phase. The market is looking past the lack of profitability for one reason: where the spending is going.
They're not just burning money on parties and snacks.
No, they are converting cash into assets, specifically GPUs. And those GPUs generate revenue almost immediately. So the report highlights this revenue trajectory that is just, it's overpowering every other concern. We're talking 80 to 100% year-over-year growth.
Doubling their revenue every single year.
That is extremely rare, and that's why investors are paying up. The report points to the price-to-sales ratio, the PS. It's the metric you have to use when there are no earnings.
Right. So how does it stack up?
CoreWeave is trading around 12.8 times sales.
12.8. Give me a comparison. Is that crazy high?
Well, let's compare it to, say, Microsoft. Microsoft is trading at about 13 times sales.
Wait, hold on. Microsoft is one of the most profitable, dominant companies in world history. CoreWeave is a cash-burning startup. Why on earth would they trade at the same multiple? That sounds completely irrational.
That is the growth at any cost premium. Microsoft is growing at, what, 15, 20%? CoreWeave is growing at over 100%. The market is basically saying, we'll pay the Microsoft price today because if that growth continues, it's going to be a giant tomorrow.
It's a bet on the slope of the curve.
It's all about the slope. Compare it to another cloud player like DigitalOcean. The report has them at about 5 times sales. They're growing, but not hypergrowth. The market is paying a massive premium for velocity.
But there's another driver in here I found really interesting. It feels almost like a geopolitical angle. Sovereign AI.
This is huge, and I think it's one of the most underreported parts of the whole bull case.
What does that actually mean, sovereign AI?
It means the customer isn't just a tech startup anymore. The customer is a country. France, Japan, the UAE. They're all realizing they cannot have their entire national AI strategy dependent on a U.S. corporation.
They don't want their sensitive national data sitting on a server farm owned by a company that also sells ads.
Precisely. They need data sovereignty. They need national security, so they're building national AI clouds. And CoreWeave, because they're a pure infrastructure specialist, can go to a government and say, we will build a dedicated cloud just for you. Your data is your data. We just provide the plumbing.
That's, wow. So unlike a Google or a Meta, whose whole business model is about using the data, CoreWeave is totally neutral.
They're Switzerland. They're the neutral arms dealer in the AI wars.
It's like a strategic petroleum reserve, but for computing power.
That's a perfect way to put it. Strategic compute reserves. And the check sizes for those kinds of government contracts are, well, they're enormous.
And incredibly sticky. Once a government builds its AI on your platform, they are not switching next year to save a few percent.
It's bureaucratic cement. It adds this layer of government-backed stability to that crazy growth story. It almost starts to look less like a risky tech stock and more like a defense contractor.
Okay, so the fundamentals are there, but let's get practical. For the listeners who are watching the ticker, what happens tomorrow? What are the charts telling us?
Well, the technical analysis section of the report is pretty bullish, but with some clear warnings.
Let's talk levels. $100 was the old ceiling.
Then in technical analysis, an old ceiling becomes the new floor. It's a polarity change. So that $100 level is now the critical support zone. That's where we expect buyers to show up in force.
The new safety net? Okay, what's the next hurdle?
The report identifies the next major resistance right around the 120 to 125 area. That's the next big test.
And the bull case, if it breaks through that.
If it can hold above, say, 105 for the rest of the week, the technical target could be as high as 140 over the next quarter, just pure momentum.
140, wow. But
there's always a but. We have to talk about the cool down.
The RSI, the Relative Strength Index.
Right.
The report notes it's pushing deep into overbought territory. It's well over 70.
Meaning the engine's running a bit too hot. It means the buying has been frantic, and that's not sustainable in the immediate short term. So the expert view is that a small pullback, maybe a drift back toward 108, would actually be a good thing. It's healthy. It lets the stock catch its breath.
So a little dip tomorrow isn't a reason to panic?
No, it's just resetting for the next leg up, potentially.
But we have to cover the other side. What's the bear case? What could go wrong here?
The report is very, very clear on the number one risk, cash burn.
Because buying all those NVIDIA chips is not cheap.
It is unbelievably expensive, billions of dollars. And since they aren't profitable, they can't fund that from operations. So where does the money come from?
They have to raise it from the market.
Exactly. Which brings up the risk of a secondary offering.
Selling more stock.
Which means dilution. Every time they sell new shares, your piece of the pie gets a little bit smaller. And the market usually reacts poorly to that news in the short term.
The stock price takes an immediate hit.
The report warns that if they announce a big capital raise, the stock could easily retrace all the way back to the $90 level.
Ouch. So the very thing they need to do to grow, buy more GPUs is the thing that could tank the stock price.
That is the high growth tightrope. It's a game of musical chairs where the music is their growth rate and the chairs are made of cash. They can't let the music stop.
Okay, so let's pull this all together. We've got this massive confirmed breakout. We've got the NVIDIA proxy narrative making them the Ferrari garage of AI. We have sovereign AI as a huge new tailwind, but we have this cloud of cash burn and potential dilution hanging over it all.
That's the whole picture. They've successfully set themselves apart. They are not just another cloud company. The report calls the trend unequivocally bullish, but warns that volatility is absolutely the price of admission.
It feels like they've graduated. They're not at the interesting startup table anymore. They're at the market mover table now.
They are, and the market is rewarding them for it.
Before we sign off, I just want to circle back one more time to that sovereign AI idea. It's really sticking with me.
It's a powerful concept.
If governments are rushing to build their own national AI clouds, and they're using CoreWeave's plumbing to do it, at what point does CoreWeave stop being just a tech stock?
That is the big question, isn't it?
I mean, seriously, if you're powering a nation's core AI infrastructure, their defense models, their economic planning, you're not just a vendor, you're a strategic national asset. You become critical infrastructure.
And what does that do to the valuation? Does the market start pricing in a national security premium? Because a government contract is a lot stickier than a startup contract.
A geopolitical asset that just happens to trade on the NASDAQ. That is definitely something to think about when you're watching the ticker.
It changes the entire risk calculation. A government is not going to let its strategic compute provider go under.
It's the too big to fail argument for the age of AI.
It's going to be a fascinating story to watch.
Well, that is all the time we have. A huge move for CoreWeave and a really interesting look under the hood. Thanks for listening to...
Don't forget to like, share, and subscribe for more.